Uh-huh.
Dollars would be a reasonable wage for $1 million business.
Uh-huh.
So that's their issue. Pennsylvania, we're not quite the same. Pennsylvania, when you make money here, then you pay tax here. If you're a resident or non-resident, they don't care. They still tax you here, right?
Mm-hmm.
So reasonable wage is only required when you're dealing with a state that's worried about unemployment insurance. And if you have to send them a $300 check at the end of the year, then it's like, okay, whatever.
Mm-hmm.
You know, it's deductible next year anyway, because
Right.
I wrote it this year, so it's deductible this year. So Pennsylvania, we don't have that same issue. You're going to pay on the $30,000 of net earnings, whether you're an employee or not, because it was earned here. So you're going to pay it here. When you move to Colorado, you're going to do a Colorado resident form and a PA non-resident form. And PA will say, well, whatever you earned in PA, we want you to pay tax on. And then because you're standing in Colorado making the money there, then you would pay tax there for that portion. So it'll kind of work itself out.
So I don't end up getting taxed in both states and having to get reimbursed at some point?
You do everything you can not to.
Okay.
So as you go through and you do your taxes, typically the way that states are is that you pay based on source income. One of the problems with the state of Pennsylvania is because you're a resident here, they want you to pay tax on everything, even if you pay in another state.
Mm-hmm.
So even if you try to apportion it, you would take a resident credit in the state of Pennsylvania. It's a problem when we work in Delaware and PA, because Delaware keeps our tax.
Mm-hmm.
So if you've ever had that happen, you'll see like you pay tax in both states and one has to reimburse the other. But whereas New Jersey, it's been reciprocal. So aside from being your own employee owner, Jersey's not too crazy unless you're missing unemployment insurance.
Mm-hmm.
With Colorado is one of those easier states where if you go and work in Colorado and you have income in Colorado, you pay tax in Colorado to that amount of income. You're a non-resident or a part-year resident in PA for the time you weren't here.
Got it. Okay, that makes sense. Okay, great. And
Does that help? Okay.
totally.
And then one of the other questions I saw you had was how do you separate out money that you've put in versus money you're taking out? You are the business.
Like basically,
So,
I'm trying to, I'll need to pay. Like the business doesn't really have any money yet, right? I mean, it's just starting up with $0 in the bank account. So how do I put money in there and not, lose any of the liability benefits by blurring my finances with the LLCs?
Right. So you are the business, and so the thing about it is when you put money into the business, if it's an expense for the business, it's deductible. If it's an expense that's not for the business, then it's not deductible. And we'll summarize all of that out on a tax return at the end of the year. So for example, if you have business income and you pay your mortgage out of it, they're going to consider that a draw or an increase in your net earnings because it's not an expense for the business. However, when you pay the LLC fees and the LegalZoom fees and the setup fees for your business before your business exists, it's still a business expense.
Mm-hmm.
So you're essentially loaning the business money. And if you want to document that and nail it down, you can write a loan agreement between you and the business and say, I'm contributing to my capital X amount of dollars for startup costs. And you can document it and date it.
And then do I at some point have to pay that back to myself?
I mean, you should.
Mm-hmm.
But in a very informal way, that'll all net itself out anyway on the tax return. Because what's going to happen on the tax return is, if you have bookkeeping software, I'm going to ask you for the summary and say, okay, just throw it at me and I'll figure it out and I'll ask you when I have questions.
Mm-hmm.
If you document it out, then it's documented out and it makes it a little bit more straightforward with less questions. But it's still the same thing's going to happen on the tax return.
Mm-hmm.
We'll go through, we'll put the income down, and then for expenses, we're going to go, oh, wait a minute, these are startup costs, so these are all deductible. And then he paid his mortgage here, that's not deductible. So essentially what happens is if you have $100,000 of income, $70,000 of business expenses, and then we see one of those business expenses is a $2,000 mortgage payment that's not related related to the business at all, then instead of having $30,000 in net earnings, now you have $32,000 in net earnings because we just reduced your business deduction by that $2,000.
Mm-hmm.
So then all of a sudden it went 100,000 of income, and instead of 70 of expenses, it's only 68.
But that
So
would
now
just
you're
be
going to get
because
only
I made.
32,000 on your K1, a personal payment out of a business account.
Instead
So
of last.
essentially, you took a $2,000 salary during the year. So we're reducing your expenses to the amount that are actually business related.
I see. Okay.
Does that make sense?
Yeah, I think
So it
so.
kind of nets itself out. So you can blur the lines all you want. At the end of the day, we're going to go, okay, he's calendar year taxpayer, January 1st.
Mm-hmm. So, you know, when I'm getting, let's say, all my checks are being deposited to my business account, and can I just have a set amount each week that I'm transferring from my business account to my personal account as my why?